Let me ask you something. When you open a chart, what do you actually see? Candles moving up, candles moving down, sometimes fast, sometimes slow, sometimes clean, sometimes messy. And most of the time, it just looks random. And if we're being honest, that's exactly how most traders feel. You look at the chart, and deep down, you're not really sure what's happening. So you start guessing. You follow momentum, you react to candles, and you chase movement. You see one strong green candle, and instantly you think, it's going up. So you enter, but then the market pulls back. Now you hesitate. Maybe you exit early, and then price continues moving higher without you. Or maybe you see one strong red candle, and suddenly you think the trend has changed. So you flip your bias, you go short, and then the market reverses again. Now you're trapped, and this cycle keeps repeating. Not because you're unlucky, but because you're reacting to candles instead of understanding structure. Because if price looks random to you, your decisions will also be random, and random decisions never lead to consistent results. But here's the truth. The market is not random. It follows structure. And once you understand that structure, everything starts slowing down. You stop reacting, and you start reading. So let's simplify this. Price only does two things. It moves up or it moves down. But the way it moves is not random. When price moves up, it pushes higher, then it pulls back. Then it pushes again and pulls back again. Push, pull back, push. That's how trends are built. Each push creates a new high. And if that new high is higher than the previous one, that's called a higher high. Each pullback creates a low. And if that low stays above the previous low, that's called a higher low. Higher high, higher low, higher high, higher low. That sequence defines an uptrend. Not one candle, not one breakout. A sequence. Now flip it. When price moves down, it creates lower lows and lower highs. That sequence defines a downtrend. And this is where most traders go wrong. They don't follow the sequence. They follow emotion. Let me show you exactly how this happens. The market is trending up. Higher high, higher low, higher high. Everything looks strong. And then suddenly, one strong red candle appears. And this is the moment most traders panic. They think, this is the reversal. So they close their buys. Some traders even go short immediately. But ask yourself something important. Did the structure actually break? If price is still holding above the previous higher low, then nothing changed. That move down is just a pullback. And because traders don't understand this, they keep getting shaken out of good trades. They exit too early. Then they re-enter too late. And it feels like the market is always one step ahead. So here's your first rule. One candle does not change structure. Now let's go one level deeper. This is where most beginners get confused. Acceptance versus rejection. If price drops into a level and quickly bounces away, that's rejection. The market rejected lower prices. But if price breaks below a level, starts closing below it, and stays there, that's acceptance. And this is important because we don't trade reactions. We trade acceptance. Now let's talk about real reversals. A real reversal happens when the structure changes, not when price moves fast, not when one candle looks scary, but when the sequence actually breaks. So imagine the market is still trending higher. Higher high, higher low, but this time price breaks below the previous higher low. Now something changed, because the market is no longer protecting structure. This is called a break of structure, or BOS. But even here, most traders make another mistake. The moment they see the break, they rush into the trade, trying to catch the reversal early. So here's your second rule. A break is a signal, not confirmation. Don't jump in immediately. Wait. Let the market prove itself. What does confirmation actually look like? It looks like the market's starting to build structure in the new direction. Maybe a lower high forms, maybe sellers start holding control. That's confirmation, because a reversal is not one moment, it's a process. Now stop for a second and think about the last trade you took. Did you enter because structure changed, or because one candle scared you? Be honest with yourself, because that answer alone can completely change your trading. Now let's make this practical. Before entering any trade, ask yourself one simple question. What is the current structure? Not what you hope, not what you feel. What is actually happening? Is the market creating higher highs and higher lows? Then the structure is bullish. Is it creating lower lows and lower highs? Then the structure is bearish. And if it's doing neither, then the market is ranging. And this is where most traders lose money, because they keep trying to trade direction inside a market that has none. Price moves up and down inside a box. No structure, no sequence, just noise. But here's the part most traders never realize. That range is not random. It's a trap. The market is building liquidity. It's collecting orders from impatient traders, buying and selling in the middle of the range. So here's your third rule. If there's no clear structure, there's no trade. Professionals wait for the breakout. Amateurs get trapped inside the range. Now let's connect everything together. Breakouts, liquidity, traps, confirmation. All of these concepts only make sense inside structure. A breakout only matters if it changes structure. Liquidity only matters if it creates a structural move. And traps only work because traders misunderstand structure. Now let's go one level deeper. This is where many traders get lost. There's a bigger structure and smaller movements inside it. Think of it like a GPS. The higher time frame is your direction. The lower time frame is just the road detail. You don't make a U-turn just because you hit one red light. And you don't change your entire bias because of one red candle. So here's your fourth rule. Always start with the bigger structure first. Zoom out. Understand the direction first, then zoom in to refine your entry. And this one habit alone can completely change your trading. Now here's the mindset shift that changes everything. You do not need to predict the market. You do not need to guess where price will go next. You simply need to understand what the market is doing right now, because price always leaves clues in the highs, in the lows, and in the structure it creates. And once you learn how to read those clues, something changes. Before, you reacted to candles. Now you follow structure. Before, you chased moves. Now you wait for clarity. Before, you guessed. Now you understand. And that is the difference between random trading and consistent decision-making. In the next episode, I'll show you how to identify when trends actually change before most traders even notice it. Because trading is not about being fast. It's about being right at the right time. And that starts with understanding how the market actually moves.